G'day guys, welcome back to the Devon Too Good Investing channel. In this video today, we're going to be diving into Alibaba's September quarter 2022 financial results, and we're going to just discuss about how the business is doing and what we can expect moving forward. So guys, before we get into this video, make sure you like this video and subscribe to my channel. So let's get right into it. So before we start talking about results, I just want to talk about the system I've used here. So I've used a bit of a traffic light system. So pretty much things underlined or highlighted in green is good. Anything in yellow is okay. And anything in red is bad. So pretty much revenue came in with 3% year-over-year growth. This is, it's okay. The reason why this is okay is mainly due to the economic backdrop that Alibaba is facing, along with government regulations, which Alibaba is also facing at the moment. And just considering everything, 3% growth year over year is okay, not great, could be worse. And we can see here China commerce, it grew. Well, it actually declined by 1% year over year. This can be mainly put down to the China COVID lockdowns. It can also be put down to just, lower GMV, which is gross merchandise value. If that goes down, which it did, it went down in the single digit percentage year over year. Obviously, the China commerce revenue is going to be affected. I've highlighted international commerce in red here. It grew 4% year over year, which is obviously faster than their China commerce business. However, I was quite disappointed with these numbers, if I'm being honest. Obviously, China commerce includes AliExpress, it includes Lazada, and it also includes Trendyol, which is this is a Turkish e-commerce platform. But out of those, I'm mainly disappointed with Lazada, because if you compare Lazada to Sea Limited or Shopee grew, a lot faster than what Lazada grew. I'm pretty sure Shopee grew revenues around sort of the 20% range. Whereas you see here, the international commerce in general just, it only grew at 4%. So let's move on now to the local consumer services. I'm happy with this. It grew 21%. This obviously includes businesses such as Ulama and AMAP and Fliggy. Nothing to be mad at here. Nothing to be mad about Cainiao, which is their logistics business. It grew 36% year over year. Cloud only grew 4% year over year, which was also a disappointment. We'll get into the reasons for this later, but just know that it only grew 4%. And then obviously they've got their digital media and entertainment. 4% growth year over year is okay. I don't really care about this business, to be honest. And then we can see negative 45% growth year over year for their innovation initiatives in terms of revenue. I've highlighted this is good, as at the moment, given the economic conditions, we want to see sort of this segment have less of a focus because it burns cash. If we look here, income from operations, it grew 68% year over year. This is mainly due to a reduction in expenses. We'll talk about that more soon. And then a reduction here in share-based compensation expense. It's down 23% year over year. So it's good to see Alibaba and their management team tightening the belt in terms of share-based compensation. We can see they've got a negative earnings per share, which is, on the surface, it seems fairly concerning. However, this is okay because because they're using gap accounting here, they include the loss taken in their investment portfolio. Obviously, these are unrealized losses, so it these numbers here are kind of misleading, which is why in this circumstance, non-GAAP measures are probably a better reflection of the business's actual performance. And we can see adjusted EBITDA, it grew 29% year over year, mainly as a result of reduced expenses. And we've got our non-GAAP EPS growing at 15% year over year. Now, if we move on to the cash flow statement and the balance sheet, we can see Alibaba, they produced $5 billion in free cash flow, which, relative to where the business is trading at the moment, that is quite a lot. So that is good. We can see that they have reduced CapEx year over year. Obviously, that's going to result in higher free cash flow, which obviously Alibaba can then choose how they distribute this. They can either reinvest back into their own business, or they can repurchase shares, which we can see that they've done. I've got a couple of red flags here. They repurchased way more shares last year compared to this year, and honestly, I'd like to see them be more aggressive with share repurchases given the valuation of the business. I think the shares are undervalued. So the fact that they're repurchasing less shares now compared to last year, for me, I don't like it. However, I've still got to look at it. They are still repurchasing shares, which it's not as much as I want, but it is what it is. If we look at their balance sheet, the balance sheet is strong. They've got a net cash position of $51 billion. So of that $51 billion, that's made up of cash and cash equivalents and short-term investments, as well as treasury and restricted cash. But they've also got a little bit of liabilities here, which we've taken into account, and you're left with roughly $50 billion. So if you think about the market cap minus this net cash position, and then if you think about the free cash flow here, you're getting at very cheap multiples. Now, if we look here at the segment results, there's only one line that I really want to point out, because we've already talked about a lot of this already, but this adjusted EBITDA year-over-year change, well, you can see that the EBITDA is increasing across their business models, except for their innovation initiatives. But you can see China commerce, it got more profitable. International commerce, they reduced expenses, it got more profitable. Local consumer services, they also reduced their expenses, and it is a lot more profitable. And all these businesses here are more profitable year over year, apart from obviously the innovation initiatives, but this isn't too significant anyway. And you can see, if you add all this up, they've increased their EBITDA, at least their adjusted EBITDA, quite significantly here. You can see highlighted in green. Now, if we look into their segments at more detailed and sort of talk about the factors sort of driving their segments of the business, we can see here that the year-over-year sort of decrease in their Chinese commerce business was due to their GMV decreasing by a low single-digit amount. I think I already discussed that, as well as lower consumption demand due to COVID and various restrictions. However, we can see that the EBITDA increased. The increase was primarily due to Taobao Deals and Taobao, a reduction in losses there, which resulted in improved operating efficiency. And we can see the adjusted EBITDA margin increased by 200 basis points. International commerce, as I mentioned, we were disappointed here by the revenue growth, considering Shopee's or Sea Limited's revenue growth. Trendyol is performing strong still, which is good to see. AliExpress is struggling. However, at the end of the day, they did reduce expenses here, which is a good thing. It leads to more free cash flow, which is what we want to see as investors. Lazada is definitely getting outplayed by Shopee, so keep that in mind. But they did reduce their losses in their international commerce business. You can see it's gone from a negative EBITDA margin of 16%, negative 16% to negative 6%. Local consumer services, I was pretty pleasantly surprised here. They've pretty much reduced their expenses here by half, but still maintain that strong revenue growth. We're looking at an increase of 21%, and this is as a result of strong growth of AMAP orders, as well as higher average order value and more efficient use of subsidies that were contra revenue of Lamar. And obviously, as we discussed, it's very good to see that they've reduced the losses here. Cainiao grew 36%. This is mainly due to the domestic consumer logistics services as a result of service model upgrades since late 2021, where Cainiao takes on more responsibilities throughout the logistics process to better serve consumers and enhance consumer experience, as well as they're dabbling in the international fulfillment solution services. And we can see that they are now profitable, whereas last year they had a small loss. Now, cloud segment, pretty disappointed here. The Alibaba thesis does rely on cloud sort of playing out if you want to sort of get into that higher echelon of returns. It only increased 4% year over year. However, year over year growth was strong in their non-internet sort of industries, such as the financial services, telecommunications, and public service industries. Non-internet industries grew 28% year over year. So they actually don't mention it on this slide, but I digged a little deeper into their press release, and that's what I pulled out. However, the internet industry it declined by 18% year over year. And you got to keep in mind that between the split of revenue, about half of it is non-internet and then half of it is internet. And this sort of decrease was driven by the fact that they've lost one of their top customers, and the ByteDance, they're the owners of TikTok, and also due to government regulations put in place, restricting online education customers, and also a softening demand sort of environment in general. EBITDA margins stayed flat for this business. But the good thing is, as this 28% year over year growth is fast growth, and if they continue growing their non-internet business at that sort of pace, eventually the fact that they've lost ByteDance, it's not going to matter, and growth should continue in this business. At least I'm optimistic around that. And then obviously digital media and entertainment, I don't care about this business. It's pretty irrelevant. The one good thing is that they've cut their losses here, so there's going to be more sort of free cash flow at the end of the day. And then their innovation initiative and their other businesses, looks like they got some AI sort of initiatives here. It's kind of weird. Their revenue reduced by about half, but somehow their losses actually increased, which is puzzling to me. But look, it's nothing too significant. It's not going to break the thesis here. So guys, overall, I'd say it was a okay quarter. It wasn't great, obviously. They were disciplined in the fact that they reduced expenses across their business, which resulted in pretty solid free cash flow numbers. They're still buying back shares. I wish they were buying back more. But overall, I'd say the management team has been pretty disciplined here with the way they're running the business. International commerce, especially performance regarding Lazada, was disappointing compared to their competition. But overall, look, if you compare Alibaba's valuation, look, I'm gonna have to do another video on Alibaba's valuation based on some of these numbers that have come out here. But if you consider their valuation versus their free cash flow, and considering the amount of cash and investments they got on their balance sheet, and the fact that they're buying back shares, it's probably pretty attractive. Anyway, guys, make sure you like this video. Subscribe to my channel. I can barely speak right now. Thanks for watching, and I'll see you in the next one.